everyone for joining. And yeah, I'm looking forward to it. Always enjoy a good chat about what's happening in the property market and what's coming next.
That's great. Welcome, Peter. Look, last week we had, no, 2 weeks ago, we finally have the first red card. Um, uh, it's already interesting to see some of the mentality change. Confidence has come back to some level, and I can see some of the ads, some of the pop up Facebook on social media, like a street record sale, all that kind of stuff coming up. Or I don't know whether it's the effect of the red card or it's something else. It's just very interesting to see. But definitely pretty much at open, you see a lot more people attending. Feels like people more willing to bid. Yeah, just a little bit of fear of missing out appears again here and there. I don't know, just it's quite interesting to watch.
Yeah,
Or
it
just
feels like
running.
it, doesn't it? Yeah, I think actually SQM research to keep a little track on how many people are actually turning up and registering for auctions, and it's definitely picked up even in the last 2 weeks. So yeah, and I think yeah, there's a few little anecdotes. We were chatting just before we started recording and before we went live, and yeah, there's just a few little examples of properties going up for sale and achieving way above what you might have expected even say 3 or 4 weeks ago. I was
Mm,
just tracking one in Bondi Junction, just a little one bedroom unit, and the price guide was $1 million, and then it was 1.05. This is an auction campaign, and then it was 1.1, and then bang, sold for 1.3. Never even made it to the auction date. So yeah, I mean, you don't want to sort of, they say the plural of anecdote is not data, but yeah, look, there's a lot of little examples of things like that starting to happen. And I think the reason, as you said, is because people have been talking about interest rate
mm.
cuts for what, a year, and they've always been just on the horizon. But like the horizon, every time we got closer to the rate cut, it seemed to just move further away. So we're finally, people are, I guess, seeing is believing, and we've had one interest rate cut. I think if you look at what markets are pricing, though, it's not for a big, deep rate cutting cycle necessarily. So if I look at futures markets, which I guess work out the implied interest rate over the next, say, 12 or 15 months, um, well, for April 2026, we're looking at about a cash rate target of about 3.5. So you could say, well, maybe two more interest rate cuts in this cycle in May and December, or maybe even three if we're lucky. But I
Oh
don't
wow.
think people should necessarily be thinking that interest rates are going to go back all the way back down to where they were. I know some of the major banks are talking about four rate cuts and all the rest of it, but
Oh
yeah,
wow.
that's if you take the market pricing as your kind of best proxy for that sort of weighted average of everybody's views. Well, yeah, two or three more cuts in this cycle, but maybe a kind of a neutral interest rate of about 3.5. And today we're at 4.1. So yeah, I think yeah, we're just starting to see sentiment pick up, and even in the daily housing price indexes, there's already been a kind of a lift. So
Mm.
whether or not that proves to be sustained is a different question. But yeah, I mean, you can see the auction clearance rates for 2 weeks in a row, stronger in Melbourne, stronger in Sydney, the big two auction markets. And yeah, I think SQM Research just updated their housing market forecasts. And now that we're in the rate cutting scenario, they're looking at price gains in nominal terms across all eight capital cities this year. Massive gains probably in Perth again with the momentum, solid gains in, well, I think things will be solid probably in Adelaide as well and
Mm.
Brisbane, and then Sydney and Melbourne just starting to turn around. And then probably at the bottom of the index for SQM would be Hobart and Canberra, where yeah, I mean those markets have had really strong run-ups over recent years, so maybe a bit more modest. So yeah,
Mm.
I mean it's early days, as they say, and there's an election campaign to come over the next 2 or 3 months, so that can disrupt things a little bit too. But yeah, I think if you were to project forward the most likely outcome over the next year, the property market's probably on the way back up again.
Mm. Yes, it's quite interesting. I was following one particular property on CoreLogic. I watched the CoreLogic's price prediction or valuation. It jumped quite a lot. What was previously 2.22, 2.23, the fluctuates. Now this week, had a look again. Actually, today become 2.3. I was thinking, oh, there must be a movement.
Mm.
CoreLogic pick it up, then project to this particular property. It's just quite interesting to watch. Um, I was watching one of the prominent auctioneer on the weekend. Watch his video. He had 10 auctions scheduled for the weekend. 3 was sold before. The 7 were all sold at Hammer in the same day. I was thinking, gosh, this has not happened for a long, long time. Seems
Yeah,
like definitely changed.
that's usually where you see that sort of A grade stock where you've got more than one
Mm,
potentially interested buyer, and yeah, people in Sydney in particular, and to a certain degree Melbourne, they've seen all this before. You know, they've
yeah,
seen property price downturns. They go for anywhere between a few months or 18 months, and then as soon as something changes, the one thing we do know about property market cycles is the demand changes much quicker than the supply does. And
yeah,
you can be talking a matter of weeks from a market where there's a lot of nerves around, and then suddenly things are off to the races. And yeah, I mean, I think that's what those people who are buying prior to auction, that's what they're thinking, right? They're thinking, let's get in ahead of the rush. And I don't want to be involved in a situation where I miss out on an auction, then I
yeah,
become one of the wounded bulls, and then I've got to go through the whole process again. And that's when you start to see people paying a little bit extra just to get something bought, and
yeah.
that's how the cycle turns.
Yeah. And also interesting thing is one person pay a little bit more, then another pay a bit more, then a bit more again. This is all piled up. They actually create a boom again, competition again.
Yeah, it's different from the stock market. You know, it's much
Mm.
less liquid. In the stock market, prices can be up 3% one day and down 3% the next. And there's loads of liquidity for most of the listed companies. But the property market, it's not really like that. You can't easily short sell in a property market environment. I mean,
Mm.
you could effectively be short if you like by never owning a property, but
Mm.
there's not the same mechanism for bringing down out of control prices. It just it takes time for supply to come online and for things to correct themselves that way.
Yeah.
So you're right. When you've got rising incomes, unemployment rate of still only around
4%, under
4%.
four. Yeah.
Yeah, the economy's adding incredible numbers of jobs, about 3.5% increase in employment over the past year. So that's pretty unusual for a rate cutting cycle to begin when you still got the economy adding what 44,000 jobs last month, and they were basically full time. So yeah, but the I guess arguably the inflation genie's back in the bottle. Wages growth it went really high, but now it's on the way back down again. We just got some more figures out today, actually, which are just worth a mention. The ABS has introduced a um, like a monthly inflation indicator. So it's not probably not as important as the quarterly gauge, but over the year to January, 2.5%. So right in the middle of the Reserve Bank's 2 to 3% target range. It was just a little bit lower than what markets were expecting. And I guess we're already a little bit below what the Reserve Bank's forecasts are projecting. So I think, I mean, it's a bit of time between now and the 30th of April when the next inflation figures are out. Um, but it probably looks like core inflation again will only be about 0.5% this quarter. So I think the reason for that, there's a few things. I mean, rents is one of them. Rent price growth was really strong in 2022 and 2023, and that even over the year to January, still up 5.8%, but it's up less quickly, if that makes any sense. It's what economists
Mm.
would call a disinflationary pulse or disinflationary environment. So down from 6.2% in December. The other thing is that construction costs, they were just out of control for a couple of years there, but they seem to have leveled off since around about June last year. And
Mm.
the new dwelling price inflation fell again from about 2.3% in December to 2% in January. So that's the lowest since the middle of 2021. It's a difficult thing, I think, sometimes for the media to get their head round. When when economists are saying inflation is coming down, it doesn't mean that prices are coming down. It effectively means they're going up less quickly in a lot of cases. So new dwelling prices might be 2% higher than a year ago, but it's better than the sort of massive growth we were seeing in the previous years. So yeah, I think yeah, I mean in terms of what happens next, the quarterly inflation figures don't actually get released until the 30th of April. So you can more or less forget any more movements in interest rates until the Reserve Bank meets on the 20th of May. And I think if you think back to when the previous elections have been around about usually what the third week of May. So we'll probably have I think we will actually have a new government by then as well. So I think
Yeah,
there's,
same as May. Yeah.
yes, that's right. So there you go. So there's a few, where are we now? February. So we've got March and April where interest rates will be on hold, but we'll have an election campaign. Then in May, the Reserve Bank, assuming those inflation figures prove to be predicted correctly, then we've got a live interest rate meeting in May, and of course the election will be out of the way. I think sometimes um, markets don't always like the uncertainty that's associated
Mm.
with an election. So yeah, I mean it could well be that as you get towards the middle of the year, that's when the cycle sort of gathers a bit of head of steam. And yeah, I think CoreLogic have done some really good analysis on which markets tend to fare best in a rate cut environment. When interest rates are rising, it pushes people into the lower price points, but then the opposite is true when interest rates are falling. People start looking further up the price brackets.
Yeah, but yeah, that's right. And I think after election, lots of dust has already settled. So there's no lot more certainty for at least the next 3 years, regardless of which party got in. Yeah, Peter, you mentioned about the 40,000 pound full-time jobs. It's quite interesting because we know lots of small businesses struggling. Some went under already, but still, what kind of job have been created? Is that government jobs or
Yeah, look, I don't want it to be a political webinar, but
okay? No.
this will be something that's probably a key point of contention in the election. Jobs growth in Australia, if you think what's happened in some other countries, like for example in New Zealand, the unemployment rate has picked up as the economy has slowed. In Canada, the unemployment rate, quite a similar economy in a lot of ways, high population growth, lots of international students, left of centre government. The unemployment rate there went to nearly 7% because the economy just wasn't creating enough jobs for the massive population growth. In Australia, 44,000 extra jobs in January. Job vacancies picked up as well. Unemployment rate is still really low. The participation rate, so the number of people actually in the labour force, all-time high, 67.3%, largely with more females coming into the workforce. So the unemployment rate is only 4.1% in Australia. The reason for that is really public sector jobs. So the private sector, as you said, a lot of businesses are really struggling current environment. Energy costs are high, interest rates are higher than they have been, costs are high, wages have gone up. But you don't really have to look too hard to see where all the jobs have been. If you just break it down by sector, healthcare employment and social assistance employment since about 2019 is up. It's just up almost like a straight line. It's up about 3 percentage points. So huge numbers of jobs in healthcare. That's some of that's a good thing. I think some of it, like the NDIS expenditure, has just mushroomed really. So I mean, there's the difference between what's anecdotal and what the data says, but I'm based in the Sunshine Coast. There's been a huge increase in the number of NDIS affiliated businesses. So yeah, I guess this is the thing in Australia. Government spending has been really strong. Again, some more figures out today showed engineering construction figures in Australia absolutely booming. They're almost all the way back up really to close to where they were in 2012 when all the mining boom was going on. And this time around, it's things like Sydney Metro, massive infrastructure projects in Melbourne and Sydney. So, yeah, anyway, long story short, yes, the private sector lots of job cuts or at least the hiring freeze, but in the public sector or the non-market jobs, absolutely booming. So now there's two different sides to this. Like the opposition will say, well, that's kept inflation higher than it
Mm,
might have been. But on the other hand, I mean, we shouldn't complain too much because the unemployment rate's 4.1%. So I think if you were being objective about it, you'd probably say you'd much rather have a 4% unemployment rate like Australia has versus say 7 in Canada.
mm,
It's clearly better. So yeah, there's lots of government spending, and that's just kind of helped to build that bridge. But yeah, probably the private sector now needs to see the cost of money coming down and
mm,
the inflation to level off because, as you said, a lot of businesses have found it really tough.
mm. Yeah, it's quite interesting with such a big number of job growth. It's double-edged sword. Just like the RBA government said the inflation is domestic cost.
Yeah, I mean, if you look at a graph of the number of people with a job in Australia, just coming into the pandemic, we hit an
Mm,
all-time high of about 13 million. Then we got the lockdowns, and it went basically down to 12. And then, in fact, if you remember, we had a second lockdown,
yeah.
which kind of knocked everything back in 2021. Total number of people with a job in Australia now, 14,634,000. So we've got, since the pandemic started, an extra 1.63 million people in work. I mean, it's absolutely incredible. When you think about if you were to sort of put together a range of scenarios for what might have happened when you lock down the economy, nobody knows what the hell's happening. I mean, we could have had, who knows, unemployment rate of 10%. We might have had 15%. To think that we're coming up to kind of 5 years on from that now, that we might have an extra 1.6 million people in work and an unemployment rate basically the lowest we've had in decades. I mean, yes, there's been some pain along the way. Cost of living has gone up a lot, and government debt had to step in. But all things considered, like it could have been a heck of a lot worse. So, yeah, they often say that Australia is a lucky country run by second-rate people. I think maybe that's a bit harsh, but it's certainly a lucky country. Again, number of times we seem to go through into these crises and come out, relatively speaking, unscathed is quite incredible.
Yeah, yeah, it is. It is. We still, and also after COVID, every family pretty much when you own assets, your net assets boomed as well.
Yeah, I mean, I guess there's always, I guess, first thing I learned as a chartered accountant, right? Double entry bookkeeping. There's always two sides to an equation. And as you
Mm,
said, I think that a lot of the focus over the remainder of this decade will be on wealth inequality. I think income inequality in Australia isn't particularly wide, but
yeah.
wealth inequality now is starting to grow. So I guess if you're a lucky person in Sydney whose parents owned yeah, let's just say a good house in Sydney, and they've put money into their super, you're most likely going to inherit a decent chunk of money, or at the very least, your parents will be able to send you to a good school and maybe help you onto the housing ladder. But of course, 30% of Australians, including myself, in fact, weren't born in the country, probably won't get anything in the way of an inheritance, and then you get this sort of inequality that the haves and the have-nots. Now, I guess, I mean, inheritance taxes are a political hot potato in some parts of the world, like in United Kingdom, for example. As soon
Mm,
as you go over the threshold, 40% inheritance tax. Lots of parts of Europe take a similar stance, but in Australia, that's not really been a thing since the 1970s. Death
mm,
duties don't really impact people, so I think increasingly you're finding well, you would know much more about this than me because you see it firsthand. A lot of first home buyers, they might have a certain borrowing capacity, but then if the parents or grandparents say, well, okay, we'll pay,
mm,
contribute towards the deposit or maybe match your savings or something like that. So,
mm,
yes, there's definitely, I mean, there was even an article in Fairfax this week saying we need to look at inheritance taxes. The problem is in Australia, which party is going to be the one to say, yeah, we're going to bring in death dues. It just would be phenomenally unpopular. So
There's
it's
political suicide.
yeah, political dynamite or suicide. So yeah, so I think that's going to be an increasingly debated subject because yeah, that what the gap between the haves and the have-nots is only going to grow, I think.
Mm. Yeah, this is actually a good well advice as well to try to get into the asset market ASAP, regardless. Well, never too late. When you can, buy some assets. It hold a long term. It will be come out good.
Yeah, I think you're right. I mean, yeah, there's lots of very cynical people on social media these days, but there's a lot of vested interests, for and against the housing market. But the reality is, you only need to look at a long-term
Mm.
graph of housing prices in Sydney and Melbourne and Brisbane to see, yeah, you do get long periods where not a lot might happen. It sometimes might be quite a number of years, but the long run trend is clear enough. I think there's two components to that. Firstly, land prices. So the New South Wales valuer reported this week that the total value of residential land in New South Wales is over 3 trillion now. So it's an interesting kind of juxtaposition really. Would you could buy Google, or you could buy all of the residential land in New South Wales. Not just Sydney, that would be Wollongong and Central Coast and Terrigal and Dubbo and basically all of it, for very similar amounts of money. And yeah, I mean it's that's one component. That the land values generally, when you get a high population growth country like Australia, tend to go up. The second thing is construction costs. I mean, we've got pretty reliable data going back 60 odd years, and construction costs basically never go down. You would think they would, but when you think about the inputs into building a house, firstly, specifications improve over time. Secondly, we've got a very heavily unionized workforce in construction in Australia, so construction wages only go up.
Mm.
And also government taxes is another massive part of new dwelling prices. So, I think the third thing is that as people get wealthier, as they generally have in Australia, the sort of aggregate household wealth is now about 17 trillion. So it's kind of tripled since 2009. As people get wealthier, they generally just spend more money on housing. That's just the way it seems to work. So, yeah, if you put all those things together, if you're sort of investing in landlocked suburbs where people generally want to move to, good school zones, things like that, then yeah, generally the nominal price of housing is only up and to the right.
Yeah, it's when you look at it, it's a very powerful vehicle, isn't it? When you started, you don't feel the much impact. Late in the later years, like 20, 10, 15, 20 years later, you see the assets massively exploded. Your cost pretty much the same. It's just like supercharge your net assets.
It's a very good place to start out. The reason
Mm.
being the leverage that you can use. I think
Mm.
if you're, yeah, I mean, for sure, if you inherit, if you if your father has an estate in Bellevue Hill or Vaucluse and you're going to inherit a load of money, yeah, don't bother. Just diversify,
Mm.
yeah, go move to the Whitsundays, whatever. But if you're starting out as somebody, you're just learning a trade or you've just graduated and you're moving into a professional career, the one thing that the residential property market can do is to give you some leverage. So you can save up, let's say, a 50 or $100,000 deposit, but you might be buying an asset that's worth 500,000 or 700,000 or whatever the case may be. I think yeah, it was interesting to see Berkshire Hathaway put out their shareholder letter this week, and I think it's the shareholder meeting with Warren Buffett this weekend or this week. And yeah, I mean, I guess they're obviously their preferred vehicle is the stock market, but don't forget if you went back to day one, how did Charlie Munger make his first millions? Real estate. He was over on the coast in the USA, saw some great
Mm.
opportunities to use some leverage and to do some development and so on. And it's a great place to start building the
Mm.
snowball. And then, yeah, for sure, later on, you'll pump up your superannuation, put some money into other assets and so on. And some people go on to build big property portfolios if that's your preferred vehicle. But yeah, it's a place to sort of get started. If you're not inheriting a lot of money,
Mm,
it's a very potentially a very powerful vehicle if you get the first decision right. And
mm,
that's why we always emphasize, yeah, we're looking at a lot of the macro stuff here, but when you actually buy that first property, you need to make sure you really do your research, do all the due diligence, and
mm,
avoid mistakes because as you said, over time, it could actually cost you a lot of money.
mm. Yeah, that's right. To buy right in the first place. Look, Peter, I want to bring back with the interest rate. You mentioned about the market predicting potentially three rate cuts. How confident are they for the two or even three more rate cuts in the cycle, which means by end of this year?
Yeah, so I mean, if you look at an implied yield curve, I mean, in effect, if it's a bit like with the bond market, it's almost like it's like a weighted average of all the views that are out there.
Mm,
So, I mean, it's possible that if the economy does really well, then we don't get any more rate cuts. But at the other end of the spectrum, if if the US economy starts slowing down, which it may well, given all the efficiency cuts that are happening over there, then we might get four or five rate cuts. So it's difficult to say. I mean, if you actually, yes, I mean, yes, if you put a gun to my head, I'd probably say two rate cuts for this cycle. But I guess we should know from history that when the facts change, you need to change your mind as things go along. Certainly, so far anyway, the jobs market has been much more resilient than anyone would have probably expected. I
mm,
think most people would have thought, yeah, okay, slowing economy. The unemployment rate went really low. It's under 3.5%, and it's gone back to 4.1, but it hasn't deteriorated really all that
mm.
much in recent months. So yeah, I guess yeah, my sort of base case scenario might be two or maybe three rate cuts, but it could be anywhere from 0 to 5 or even more. Who knows?
Yeah, it's hard to predict. But one thing I want to ask you is, do you see what potential opportunity do you see? Because look, if we wait for the rate cut all come in, it's probably too late. The boom already happened. So now it's kind of we don't really know how much rates going to cut, but we know there'll be more come in at some stage. Where do you see the opportunity before the mass media discovered?
Yeah, I think. Well, I mean, there's an old sort of cliche of real estate. And it's been something that's been pushed over the years that the best time to buy is now, and the second best time was 20 years ago. But I think in this particular case, that if you're going to invest in this cycle, I would probably say do it sooner rather than later. Reason being, and this is not opinion based. This is just what I've picked up from research. If you look at look at what bookmakers are predicting for the election results. So they've got the coalition at $1.50 and Labour Party at $2.60. Now, I mean that to me looks like I think the election's a lot closer than that. It's if you look since World War II, I don't think we've had a new government, only have one term. I think it's nearly always with our short electoral cycles in Australia, nearly always you get two cracks of the whip. But let's say, for example, the bookies are right and the coalition wins the election. Well, the coalition has said very quietly that if they win the election, they're going to effectively force the market regulator, which is in Australia is APRA, the Australian Prudential Regulatory Authority, to actually have a look at changing the lending assessment buffer. So look,
Oh,
yes,
that's all
so yeah, so
best.
this is more sort of your area of expertise than mine, but in plain English, for anyone who's not familiar. So basically, at the moment, well, when interest rates were very low, the regulator introduced a lending assessment buffer of 3 percentage points. So if you were borrowing at, let's say, you won't get it today, but let's say you were borrowing at 3%
Mm,
on a mortgage, the mortgage brokers like Eric or whoever's writing the loan would need to run a stress test effectively to show that you can comfortably make the repayments with a mortgage rate of say 6%. That's so
mm,
3 plus 3.
mm,
But then that lending assessment buffer has stayed in place all the way through until now, when interest rates are not only no longer rising, they're actually falling and projected to fall further. So normally, I mean, just by way of comparison, the Bank of England insists on a 1%, 1 percentage point buffer. So, while we've got 3 percentage points when interest rates are going down, yeah, you could argue that's shutting out a lot of low income earning households. But yeah, so what the coalition is going to try to do, it wasn't specific, but they did say they would try to get the regulator to loosen up a bit. So now it doesn't mean that it'll come back to 2.5 or 2 or whatever, but what it might mean is that for certain cohorts, for example, first home buyers, or maybe people refinancing, maybe those rules are loosened. But one thing I do know from 25 years of watching property markets is that when interest rates fall and lending is loosened and you get kind of a mortgage war or competition between the banks, well, that's going to tee off a housing market cycle. It's particularly in Australia where we've got population. I think immigration is predicted to be plus 440,000 this year. Plus, we've got another 100 to 150 of natural growth in the population. We've got a housing shortage in virtually every part of the country, not everywhere, but almost everywhere. So yeah, so that would be my first point. Do it sooner rather than later if you're going to buy. Don't wait until the election's out of the way, interest rates have been cut again, because it'll be you and 1,000 other people. I guess, well, I'll cross-reference here to Eliza Owen at CoreLogic because she's done a data crunching exercise and looked at previous property market cycles and looked at, well, when interest rates start to fall, which are the markets that tend to benefit first? And yeah, look, generally, the more expensive markets will benefit because they've been the most stretched by higher interest rates. So basically, inner city Sydney, Melbourne, the more sort of the higher end properties in Brisbane, and then generally what happens in most cycles is that Sydney leads, and then maybe a year or 18 months later it filters out to other parts of the country and other regional markets. So yeah, I would say there's a big shortage in Sydney at the moment. They're just not building enough. Population growth massive. I think just anecdotally, I think that cycle might already be underway. So look, as you said, I operate in Sunshine Coast, Gold Coast, Brisbane, Newcastle, Central Coast. So of course, I would say good opportunities in those markets because that's what we do. But I would say though, if you've got a budget of let's say 650, 700, well, I would probably take a look at Melbourne, to be honest. It's been the weakest capital city for a little period of time. It's still a big wealthy city with a lot of head offices. Second most popular city for new arrivals into the country. So yeah, it's had some challenges with lockdowns and sentiment and state debt and so on. But in terms of sheer value for money, probably, yeah, I'd say suburban Melbourne. If you look carefully, there's probably some good opportunities there.
Yeah, sure. I think give you an example, 700,000. In Sydney, you won't have much choice. It's probably a two-bedroom apartment.
Unless you go all the
way
deep into the
west.
suburbs. Yeah, that's right. So if you want a house and you want to be in the inner suburbs, well, yeah, for sure. You're probably going to need to push that budget a bit higher. So, and look, it depends, a first-time investor might not have such a big budget, in which case, yeah, you might need to look at some of the regional markets or go quite a long way out into the suburbs in Melbourne or so on. So, but yeah, probably a good starting point is have a chat to your mortgage broker like you guys, see what you can comfortably afford, and just make sure that the numbers stack up. So if you need a rental yield of 3.5% or 4% or whatever it may be, and then once you've got the budget, well, then you can start to look at, okay, well, if my budget is 6 or 7 or 800,000, which markets might be the most appropriate for me?
Yeah, that's right. Yes, you mentioned about the budgeting. I think the best idea is probably before you target any market, talk to your bank or the broker to find out your borrowing and have different strategies. What kind of price range you are targeting. It's probably more targeted and narrow the research rather than cast the net really wide. It's probably lots of time spent it for not much result.
Yeah, for sure. Now, Eric, when we spoke last time around, I think if you recall, there was just the first inkling from Treasurer Jim Chalmers that uh, upcoming, then the treatment of student debt would
Tax.
be
Yeah.
likely to change. Now, I think when we finished off last time, we said, well, maybe we'll cover that this time around. Do you have any sort of thoughts on um, how widely that might be applicable to people, what kind of impacts it might have, whether there's any fine print that people need to have a think about?
Yeah, look, I think this is interesting. I don't know, because all the lending is under big umbrella for responsible lending, right? My bank is supposed to assess your ability to repay. Um, if you exclude the hacks, unless you stop people being charged hacks, how can the bank ignore the hacks payment liability? But
Mm.
if this does get implemented, there would be some people get really benefited because I have some client young, fresh out of uni a few years or not fresh out of 3 to 4 years, good income but with hacks. It's very difficult to borrow the desired amount. But if the hacks can be excluded, their borrowing can be increased by quite a lot. Each person different. It can be 50 grand to nearly 150 grand. It depends on income because the hacks are calculated on the person's income, the repayment. So look, I don't think it's going to have a major impact across the board, but a particular group will definitely benefit, especially first-time buyers. If you want to look at the little more reasonable average house, like medium house in Sydney, 1.6 mil, if the hacks repayment be excluded, lots of people will not the decent percentage of first home buyers will be qualified for that. But again, look, I think this is something really needed to be considered. Really need to consider because you cannot. How can you exclude the tax repayment from person's finances?
Yeah, it's a bit of a paradox, isn't it? Because
Yeah,
we've got those responsible lending regulations, and then we say, okay, but you can just ignore these for this specific cohort. And yeah, I mean, sometimes you think the same with some of the government policies that are put in place, like stimulus packages for first home buyers, and it's kind of like you've got the regulators pulling in one direction and
yeah.
the state government's pulling it in another. Yeah, I think just a more general point, I suppose, in terms of macro strategy. Yeah, I mean, this is not personal financial advice, just a general observation. I was reading the Berkshire Hathaway annual statement or the state letter to shareholders this week, and yeah, I guess it was quite interesting to see that yeah, Warren Buffett has been effectively offloading their equities now for on a net basis for 9 quarters, so for over 2 years. And when you look at one of the sort of popular indicators that he used to like to
Mm,
look at was the total value of the stock market versus GDP. And I think he said in the run up to the tech bubble, if the value of the stock market gets up towards say 200% of GDP, you're kind of playing with fire. Well, I
mm.
guess in recent months we've kind of gone over blazing over the top of 200% to about 210 or something. So I think this is what I'm doing at the moment, and other people, you got to sort of speak to your financial advisors and your mortgage brokers and so on. But I think it's yeah, I think there's definitely some good opportunities. So I've just bought a property myself, but I think over the now I've got that property uh, under contract and due to settle. I think my thing over the next 6, 12, 18 months is now to sort of build up an offset account because mortgage rates are still, yeah, depending on who you're borrowing with, there might be 6% or you might be paying 6.5 or whatever. So it's not a bad place to sort of build up a bit of a buffer, reduce risk and so on. I'm not rushing to get more money into my super or the stock market at the moment because yeah, I mean the stock market is just not particularly cheap. So I think there's it's going to be a good little period for property over the next few years as interest rates come down. But at the same time, yeah, I think people just need to be a bit have realistic expectations of where interest rates are going to go to, and they're not going back to 2 or 3% for mortgages. They might go
Mm.
down to towards five or something like that. So I think it's just still important you sort of manage your cash flows, don't overstretch. Um, and yeah, Australia's mortgage offset facilities or redraws, they've been really popular over the past 15 years or so. And I don't think it's a bad time to build up a bit of a war chest as well for any opportunities that might come around over the next few years.
Mm. Yeah, yeah, that's very, very good advice. I was thinking, look, even the 5% still that's big relief because we come from 6.5. That's where the peak, I think. Lots of people struggle. If we reduce 1.1.5%, that's massive. I think that will be a big relief for the cash flow.
Hmm.
That we
Oh,
can afford
huge.
the
Yeah, huge difference. Yeah, I think
yeah.
everybody's felt it. I mean, we were living the dream for a year or two there with 2% mortgages, but as those fixed rate mortgages started to reset to 6 or 6.5, suddenly it's like, whoa, that's a quite a change in the
It's
cash flow.
massive.
Yeah, and it's not just a once-off change. That's every month you're getting smashed with.
Mm.
And yeah, people might say, well, yeah, historically 6.5% mortgage rates are not that high, but yeah, you also have to look at the inflation targeting period since 1993. Well, they are relatively high for anything we've seen since 2009. And yeah, I guess you also get used to the lower mortgage rates. A lot of us did, and then suddenly it's like, oh yeah, maybe I need to cut back on spending, or maybe not spend so much on a new car this year, or whatever it may be, or holidays and things. So yeah, but I think yeah, despite all of the scaremongering about mortgage delinquencies and defaults and so on,
Mortgage cliff, all that.
yeah, it hasn't really happened, has it? I think
Mm.
it's shown up mostly in retail sales. So retail turnover's calmed down a bit. I think, yeah, people have cut back on some of their discretionary spending, but yeah, mortgage arrears have actually been very low. I think, to be fair, some of the banks actually did allow people to have to put their mortgages in to put them in what's the phrase
Payment
I'm looking
plan.
for?
Yeah, payment plan can be.
Exactly, into a payment plan, or in some cases, they push people onto interest only just to give them
Mm.
some breathing space. So, yeah, maybe those 30-day delinquencies don't show the full picture, but even accounting for that, you can see over the past 6 months, the those figures in emergency plans or whatever
Mm.
they may be are coming right down again. So, I think it's yeah, I think all things considered, the housing market has been tremendously resilient, given that we saw the most rapid tightening cycle we've seen certainly any time in recent decades, and all things considered, things held up very, very strong.
Yeah, that's right. And today I read something interesting. I'm not sure whether true or not. Yeah, they're talking about Peter Dutton has 26 properties. How many does Anthony Albanese have? Quite a few, five or four?
He did have, this is going back a few years. I think he had one in the inner west, didn't he, which he might have sold. And I
Mm.
think he bought a place, if I'm right in thinking, up the coast. But, I think, yeah, it's like, as I say, it's not a political webinar, but in Australia, this is relatively small fry. I think it's always amazing to me in the US how people go into politics and then maybe an income of 150,000 and suddenly they've got a net worth of 150 million. It's like, well, where
Yeah,
did the
that's
rest come
right.
from? Hasn't
That's
come
right.
from the salary. So yeah, in Australia, yeah, it's relatively speaking less dramatic. But yeah, I mean, I think there was a stat that showed I think out of all the MPs, I think only 12 of them don't own property because they obviously have to disclose
Mm.
their asset ownership. I think only 12 of all the MPs are not property owners. So yeah, I mean, people say there's a lot of vested interest there. Yeah, I mean, it's probably true, right? Most people who own assets don't like to see the value go down, that's for sure. And I think actually, didn't Claire O'Neill say that the goal of the government is not to bring down prices, it's just to make them go up less quickly or something? I don't think it went down well as a soundbite, but it's nevertheless probably true.
Yeah, that's right. That's right. I was thinking, look, if the police, the high-profile police can see property as a vehicle, well, which we would have more confidence on that because they would have more information than us.
Yeah, for sure. Well, that was one of the Labour Party's dirt unit tried to dig up some share trading activity from 2009. But yeah, the property market is different in the sense that you don't really
Mm,
have insider trading, except actually there was an incident in I won't mention the specific uh, politician, but there was a with the new rail going in Brisbane, and one of the politicians had bought an investment property just magically near. So yeah, so I suppose you might get insider trading in inverted commas in terms of locations, but it's not really. It's a very big and a liquid market. It's not like buying shares in a mining company or something where you might have some genuinely useful inside information.
yeah.
But yeah, like as you said, I think. This is one of the things. If you actually look back at the total return from the Australian stock market versus the Australian property market over, let's say, 100 years, they're incredibly similar. And
Mm,
but it kind of makes sense if you think about it, because generally what happens when businesses generate profits, that you might have seen, maybe a 10% per annum return from the stock market over a century. But as people get wealthier, they put more money into housing. So,
mm,
there's periods where property does better and shares do better and so on. But over sort of many decades, the returns are much more similar than they are different. The reason that property is so popular, of course, as you mentioned, is because you can use your money plus the bank's money.
mm,
Um, Historically, it was much harder to do that in the share market. You could do it with margin loans and until 2007, 8, 9, when the stock market crashed, and then margin loans kind of went out the window. But now with leveraged ETFs, you can use leverage in the stock market as well quite easily. So there's other tools as well, of course, like options, CFDs, and so on. But
mm,
yeah, I guess the thing with residential property is a totally unique asset class because it's an asset, but it's something that you consume effectively, somewhere you live.
mm,
But also, where else are you going to get a loan with a 30-year term on a low mortgage rate? There's no margin calls. It's a completely unique triumvirate of lending
mm,
conditions. You wouldn't get it on any other asset. So that's where property is powerful. As you said, if you buy well and hold for the long term, it's like a compounding machine effectively.
mm. Yeah, it's kind of you pay 20% deposit to holding 100% of assets, and you have the 100% benefit of the growth of the assets.
Yeah, and it's actually more the real hidden benefit that never gets accounted for in all these
Mm,
calculations is that let's say you use this 20%, so 200,000 on $1 million property. Yes, you've got stamp duty of maybe 50,000, but then let's say you get 50% capital growth over a number of years, but then you can just go back, take some equity out of that property and use that to buy the next one. So, what's your return on your 200K then? It's kind of then you've got two assets that are
mm,
working for you. Yeah, usually in the stock market, you're putting in more money over time to grow the portfolio. But in property, I mean, I know some people in their 70s who started off with one property and they just used the portfolio to keep growing it. They didn't put extra money in. So yeah, it's a very unique asset class if you make a few good decisions. I don't think it's a bit different from the stock market where you might be buying and selling regularly.
mm.
You make far fewer decisions, but the ones you do make are potentially much more important.
Mm. Yeah, yeah, that's right. The property is not for trading; it's only for long-term holding, really, and also value adding. But Peter, I want to ask you a question. The both parties talking about they're going to stop the overseas buyers to buy the new property for 2 years. Do you have any data to see how many people will be affected? I read somewhere say it's only 0.5%. Or was it?
Yes, yeah. I mean, yeah. Look, years ago, I was involved in
Mm,
there was a bit of a crackdown. I think if you remember under the Joe Hockey years, I was sort of asked by the ATO to advise on various bits and pieces about, where in the market does foreign capital have an impact and so on. So just to explain, so essentially what happened was the the opposition party, the coalition, said that if they won the election, they would ban temporary residents in Australia from buying established homes. So normally, Australians can buy anything, foreign buyers can buy new property, or if they get if there's approval from the Foreign Investment Review Board, then they could potentially buy an established home. Um, so yeah, in terms of stats, so the figures are always really slow to come out. The most recent figures from the Foreign Investment Review Board are only for financial year 2023. So
Mm.
the 2024 figures up to 30 June last year still will be due fairly soon. And I think off the top of my head, it was something like 5,360 or something like that. That was the number of uh, temporary residents who bought established properties in Australia. So as you said, it's less than 1% of transactions in the housing market over the course of a year. But I suppose, yeah, like in certain pockets, I think you could probably say that foreign capital does find its way into established housing. Just by way of an example, let's say um, a Chinese
Mm.
student comes to study in Australia. I'll just pick Chinese because that's the biggest cohort, but you could say
Yeah,
India or
yeah.
wherever. And then some family says, well, like if you're going to Australia, maybe you should buy a unit while you're there. Maybe you can apply for Foreign Investment Review Board approval. And in fact, this did happen. There was quite a high profile property, but this is going way back about 2011 or something, where a
Mm.
student had come to Australia, gone down to Liverpool Street and bought the most expensive penthouse. Like as you do, slightly different from my student days living on baked beans. But you can see how in that circumstance, maybe there's a pathway for capital to come in via family, friends, or whatever. So I think, yeah, look, potentially in certain pockets, and there's certain suburbs like say Hurstville is very big Chinese population, or there's other suburbs that are big Indian population. Yeah, I think like maybe in certain pockets, and Brisbane we have the equivalent where foreign capital could actually be making quite a significant impact. But does closing off that particular loophole stop it? No, not really. So I think it probably makes a bit of a difference at the margin, but in the context of a housing market that's worth 11 trillion plus
Mm.
with maybe 500,000 transactions, it's not really in a year. It's not going to be a huge factor.
Yeah.
And in any case, yeah, I think if people are really motivated to find ways to get money into the property market, they could probably still do it anyway.
Mm. Yeah. I heard somebody was saying, look, with this overseas buyers buying here, they're quite a large percentage of buying the high end property, like 10 million, 15 million,
Hmm.
20 million. But with that kind of property, so what to do with us? I mean, nothing. Does not affect the normal housing market. We're never going to buy a 20 million house anyway, really. Whether
Yeah,
us,
well, yeah, I mean, I think in London
mm,
over the years, for a number of reasons, there was no restriction on foreign buyers. There was no capital gains tax for foreign buyers. So it almost became prime central London was just a place where particularly Malaysian capital used to flow, but also Russian capital,
mm,
actually money from all over, China as well, USA. Yeah, Australia probably less so, but you can certainly see why if somebody's got a large wealth in a country in Asia or something like that, they just want to diversify
mm,
and get housing is as good as anywhere to put it. If you get a good block of land on the harbour side in Sydney, I mean, yeah, again, it's one of those things where there's two sides to the equation. The government doesn't hate it because they get a massive amount of stamp duty, potentially land tax as well. Um, it's almost like an export in one sense because it's bringing in wealth into the country. We previously had significant investor visas in Australia, whereby
mm.
if you had over $5 million investable, you could effectively buy your way into a residency and then get your capital in that way. But yeah, there's always another side to it, and that is if it makes the housing market overall become overcapitalized, well, it further down the ladder, it becomes harder for people. But yeah, I guess I think when you actually look at the previous construction cycle, in Australia, that was very largely driven by Chinese buyers in the apartment market. So
Mm,
I think it's been possibly a mistake to have the stamp duty surcharge for foreign buyers because we've now got a massive shortage of housing. And yes, the government can keep announcing new targets every so often, but they're not actually hitting them. So I
mm,
think dwelling completions are running well, about between about 40 and 45,000 a quarter, but yeah, population growth has been obviously way higher than that. So we probably need to be building about 60,000 a quarter, and without the foreign buyers in the new apartment market, it's just not happening basically.
mm. Yeah, that's true. That's true. Peter, we discussed about the buyers we should buy when they're ready. What about if people want to sell in this kind of condition? Should we hold for a little while, see the market returning, picking up, or you to sell when the things they need?
Yeah, it depends where. Like, so just
Mm,
full disclosure, I sold the property around about November last year, and just selling another one at the moment. So, like, I think it depends on the market. Really, people aren't very good at this because people tend to follow the crowd. But generally speaking, you want to buy when the market is out of favor, and you want to sell when there's a frenzy.
mm,
So it depends where in the country you are. If you've got a property in Perth that's gone up 70% in 3 years, well, yeah, maybe it's not a bad time to have a look at
mm,
if you're thinking of selling and not holding for the long term.
mm,
I think there's potentially other markets where the cycle hasn't really picked up yet, like in Melbourne, for example. So I think it kind of depends where you are. And also, yeah, you've got to look at it in the context of your own portfolio. I
mm,
think one of the things I've learned from working with Catherine Cashmore, a land cycle investor, is yeah, for sure there's a market cycle, but I've got a few properties, maybe four properties in my portfolio. I would just never sell. They're just too good. But then I've got other properties that are kind of like, I've been self-employed for the last 13 years or so, and sometimes I couldn't, couldn't borrow enough to get the property I wanted. So I've got some okay properties, like a couple of units and so on that, they're okay and they've done well, but maybe not forever A grade assets. Well, for those, maybe, maybe that if there's a frenzy, market cycle really tees off, well, maybe that's the time to offload those. So I
mm,
think it really depends on where you are in the country, what type of property, and
mm.
also, of course, your own personal situation as well.
Mm. Yeah, I had some client ask me they bought in Brisbane. Yeah, that's just before the boom, 2016 roughly. Now the price nearly tripled. Well,
Mm.
more than no, you not triple yet, to at 250%. Yeah, they're thinking of selling, and also they're thinking, oh, Brisbane's still booming. Actually, should we hold or should we sell now?
Yeah, so if you're not sure, I mean, I guess ultimately there's two things. One is the numbers game. So
Mm,
if you sell in Australia, you'll pay capital gains tax. So if you've owned the property for over 12 months, you will get a 50% discount, but it's still,
mm,
you still might pay, let's say, 20% CGT or something like that.
mm,
So that's annoying, if you've got $1 million capital gain, but then you have to give 200 or so to the government.
mm,
So if you can refinance and not have to do that, that's one potentially good thing. But on the other hand, there is a kind of a path of least regret, and if you've had a bonanza or a jackpot win that you weren't necessarily expecting, and yeah, in my case, I had a unit in New Farm that I bought. It was okay, wasn't amazing, just had a nice view and so on. But the price just went whoosh. And I thought, well, yeah, I was never expecting that to happen. And I just figured, yeah, it could keep going, but I think I'll be pretty happy with the gain that I got over 4 or 5 years was much more than I was hoping for. So I thought, well, why not? I can sell this, pay a bit of tax maybe, and then
mm,
and then move on, put the capital somewhere else. I've got some other renovations that I want to do and so on. So yeah, I think those are your two sort of factors. One, think about the financial and the tax implications, but also think about your personal
mm,
strategy. And yeah, as they say, you don't go broke backing winners. Paying tax is sometimes unavoidable. But if you can refinance and keep the asset as well, then maybe that's a good option for you.
Yeah, yeah. Everybody's different. Mm. Yeah, look,
Yeah.
do you have anything more? Because I'm being mindful with the time, 1 hour. Last words wisdom, please.
Yeah, I think there's a couple of big trends to keep an eye out for. I think one is like the construction cycle. So at the moment we're really short on housing, but that won't continue forever. Like every cycle we think, oh, we'll never build enough housing, and
Mm,
then magically everyone starts building at the same time, and then we get an overbuild. So that's one thing to keep an eye out for. I think over the next 2 or 3 years is when does that construction cycle, particularly for new apartments in Sydney and Melbourne, when does that start to pick up? I think another thing is there's been a massive shift in the way in which people work. So I think the working from home phenomenon, yes, there's a lot of people being called back into the office, but I think in a lot of cases people are only going back, say, 3 or 4 days per week. So there's a lot of pressure on office space at the moment. Prices are really struggling in Melbourne, other parts of the country. But that's the other thing, is just to try, there's an old saying in real estate, apart from the best investment on earth is earth. But yeah, the other sort of cliche is find out where people are moving and buy the land before they get there. I think that's the other thing to watch is where are the demographic flows happening? Are some people getting pulled back in towards their office jobs, in which case you're either going to be looking at capital cities or those regional cities, maybe within a 2 hour sort of sweep of the capitals. So
mm,
yeah, I think those are the two of the sort of key things to watch over the year ahead. And yeah, as I say, just probably just plan if we get a few more interest rate cuts, fantastic. But I wouldn't base my strategy on that. I would just treat every rate cut as a bonus, but just try and be a little bit mindful that you might not get as much as you think.
mm. No, that's excellent. Thanks, Peter. Really appreciate it. The very valuable info session today.
Yeah, pleasure. Thank you. If anyone wants to book in a chat, I'm always happy to have a chat to you. Yeah, petewargin.com or Pete Wargin Blogspot. I'm fairly easy to track down. Always happy to have a 15-minute chat. So if you've got any questions or you just want to book in a strategy call or whatever, always happy to.
That's great. Thanks, Peter. Really appreciate it.
Great. Thanks, Eric. Thanks, everyone. Great to be on as always and look forward to the next one.
Yeah, we're looking forward to it.
Cheers. Thanks.